Welcome back to Deegan's Journal, where we decode the headlines before they hit the markets. This week, while everyone's watching the charts, the real action is happening behind the scenes. The European Central Bank is testing blockchain settlement with real euros. Bybit and OKX just went fully legal in Europe under MiCA. Standard Chartered says Bitcoin's heading to $135K. And Grayscale's new ETF, it's packing Solana, XRP, and Cardano into Wall Street portfolios. But here's the twist. Regulators are quietly building the rails for a new financial system, one you may not be ready for. Let's break it down. Story 1. The ECB prepares to bridge the old world with blockchain. The European Central Bank isn't just talking about blockchain anymore, it's building the infrastructure to run on it. Under a new two-track initiative, the ECB will pilot a blockchain-based euro settlement system by late 2026, a move that could fundamentally change how money flows in one of the world's largest economies. The short-term track, codenamed Pontes, Latin for bridges, aims to link existing DLT platforms, the underlying tech of public and private blockchains, directly to target services, the backbone of the Eurozone's payment and settlement network. This is a massive signal. Target is not some side system, it's the core financial artery of Europe. If DLT platforms can connect directly to it, that means blockchain-native assets could soon settle in real central bank money, with speed, transparency, and regulatory oversight. But this move isn't blind. It's the product of over 50 DLT trials run by the ECB in 2024, involving 64 financial institutions, including major banks and payment networks. Those experiments now form the foundation of the Pontes pilot. The timing also matters. With MiCA now active, and private stablecoins beginning to gain ground in the Eurozone, the ECB is making sure that public money, not just corporate crypto, stays relevant in a tokenized economy. Bottom line? This isn't a CBDC rollout. This is infrastructure-level transformation, the kind that prepares Europe's monetary system for full blockchain integration. And it could become the global standard for how central banks interact with DLT. Story 2. Bybit and OKX go fully regulated under MiCA. While the US still struggles with crypto legislation, Europe is quickly becoming the global playground for compliant crypto innovation. This week, two of the world's top exchanges, Bybit and OKX, launched fully regulated platforms across the EU, leveraging the region's new MiCA regulatory framework. Let's start with Bybit. They've officially launched Bybit.eu, a MiCA-compliant platform based in Austria, with a CASP license that authorizes operations in all 29 EEA countries. It supports multiple languages: English, Polish, Portuguese, Spanish, and plans to expand into German, French, and Italian soon. But more importantly, it aggregates liquidity from multiple providers, offering deeper books and better execution for both retail and institutional traders. Then there's OKX, which just launched a fully regulated exchange in France via MiCA's passporting rules. This allows OKX to operate legally across the EU with a single approval, a huge advantage under MiCA's harmonized regime. Their platform includes Eurospot trading pairs, crypto staking, trading bots, and localized customer support in French. But here's the key insight. These companies aren't avoiding regulation, they're leaning into it. Because for serious players, regulatory clarity means market access. It means you can plan, scale, and attract institutional capital without legal fog. Europe's not just setting rules, it's setting the pace. And MiCA is becoming the gold standard for global crypto compliance. Story 3. Standard Chartered says, Bitcoin to $135K by Q3, $200K by year-end. If you thought Bitcoin had already peaked in 2025, think again. Global banking giant Standard Chartered just dropped one of the boldest crypto forecasts of the year. $135,000 BTC by the end of Q3, and a potential surge past $200,000 before New Year's Eve. This isn't just hopium, it's a macro shift backed by real capital flows. According to the bank's digital asset lead Jeff Kendrick, Three major forces are fueling this new bullish narrative. Massive ETF inflows. The post-approval floodgates for spot Bitcoin ETFs have opened the door to institutional buyers worldwide. The old retail-driven cycle is being replaced by pension funds, sovereign wealth, and hedge funds stepping in with billions. Corporate treasury allocation. We're now seeing large public companies, not just crypto-native firms, adding BTC to their balance sheets. This includes firms outside the US, signaling global de-dollarization hedging in action. The death of the halving myth. Historically, BTC would crash around 18 months after each halving, but according to Kendrick, that cycle has now broken. ETF demand has created a new price floor, structurally altering Bitcoin's supply-demand dynamics. So what does this mean? We may be witnessing the institutionalization of Bitcoin as a macro asset class, a shift from digital speculation to digital gold with global liquidity. And if Standard Chartered's prediction holds, the second half of 2025 will be historic. Story 4. Binance CEO, Bhutan's happiness model aligns with crypto values. What happens when crypto meets one of the most unique national philosophies on Earth? During the Binance crypto tour in Bhutan, CEO Richard Teng made a rare but powerful connection between blockchain and Bhutan's gross national happiness, GNH, a system that prioritizes well-being over GDP. While most countries measure success in dollars, Bhutan measures it in harmony, mental health, and community strength. And surprisingly, Teng argues that crypto fits right in. At its core, crypto is about financial freedom and inclusion, said Teng. It's a tool that improves well-being by giving people access to capital, removing barriers, and protecting individual sovereignty. In Bhutan, that message hits different. The Himalayan kingdom has long embraced tech, with care from carbon-negative goals to blockchain pilots in education and identity. Teng's remarks suggest crypto isn't just compatible with Bhutanese values, it might amplify them. Why it matters? This is a reminder that Web3 isn't just about price action, it's also a cultural and philosophical revolution capable of adapting to models far beyond Western capitalism. Story 5. Grayscale's Large-Cap Crypto Fund becomes an ETF. In a landmark regulatory moment, the US Securities and Exchange Commission, SEC, has officially approved the conversion of Grayscale's digital large-cap fund into a full-fledged exchange-traded fund, ETF. This isn't just another Bitcoin ETF. Grayscale's new product includes Bitcoin, 80.2%, Ethereum, 11.3%, XRP, 4.8%, Solana, 2.7%, Cardano, 0.81%. It's the first multi-asset crypto ETF of this scale approved in the US, and it represents a critical evolution in how traditional markets will gain exposure to the broader crypto ecosystem. Historically, Grayscale's crypto trusts were known for NAV premiums and arbitrage plays, often trading well above or below the actual value of their holdings. But with ETF conversion, those inefficiencies shrink. Liquidity increases, transparency improves. In short, this is crypto entering mature capital markets not just one token at a time, but as a diversified index product. It also opens the door for crypto basket ETFs, new portfolio strategies, and more Wall Street native tools to onboard the next wave of investors. Bottom line? This is legacy finance bending toward Web3, not resisting it. Crypto regulation is tightening in Europe, ETFs are accelerating adoption in the US, and the world's central banks are piloting blockchain solutions. The global transformation of finance is not coming. It's happening. Subscribe for more weekly deep dives into the future of money and let us know, which story do you think is the biggest signal of what's to come? Keyword for the comments: bridge.